Well, hello everyone. Welcome to Getting Started with Technical Analysis. My name is Barbara Armstrong. I am a coach with Schwab and delighted that you are joining me for this introductory level class. Today we are going to talk about divergences and indicators and what those might mean for us or what story they might tell us as technicians looking at charts. And if you're new to all of this, don't think like, ooh, this is, a tough topic. We're covering this at an introductory level. This is, I think, week 9 in our 9-week series. I'm going to add a 10th week, and next week we're going to talk about Fibonacci's. That's on the menu for next week. So, make sure you come back. But let's get right down to business. If you are not following the coaches at Schwab on X, you are missing out, my friends. Consider this your invitation. My handle at Barb Armstrong CS. Have the privilege of having Cameron May with us in the chat today. He's a friend and a fellow coach, and he posts some great content on X as well. You'll want to check that out and follow him at Cameron May CS. Okay, so somebody said, oh, bummer, it's snowing again in Michigan. You know what? Spring always tends to throw wacky weather our way, right? I spoke with a friend who lives outside of Toronto last night. She now has power again after getting hit with an ice storm. Like it was so severe. I mean, she had no power for 8 days. My brother said that if you went for a walk, you had to kind of walk down the middle of the street because there were so much ice on the trees that they would you'd hear a snap and a bang and a whole branch just couldn't take the weight of the ice and would just fall to the ground. Yeah, so pretty crazy stuff happening out there. So wherever you are, whatever the weather is throwing your way, I hope you're able to smile through it. Just as, we've been smiling through some of the craziness happening in our world, both globally and it certainly had an impact on the markets. So know that everything that we talk about in this class is for general information purposes only. None of it is to be construed as a recommendation or an endorsement of any particular investment strategy, chart pattern, or individual stock. Know that options carry a high level of risk and aren't suitable for all investors. You have to meet certain requirements in order to trade options with Schwab. For our examples today, and we're going to look at a lot of different stocks. I have quite a long list. So it's a divergent world out there. I'm just kidding. But, the paper money software application on the Thinkorswim desktop platform is the platform we're using. There are some nuances and differences, and we'll discuss those as appropriate. Okay. Yeah. And so, we kind of did a little bit of a reboot. Cameron May has taught this class for years and created a lot of really great content. This is kind of our, slightly tweaked series. And like I said, today is, lesson 9. I'm going to add next week a lesson 10 on Fibonacci's, and then we'll go back to the beginning of the rotation. And we're always looking at this in the context of not only understanding what these basic fundamentals of technical analysis are, but also, looking at applying that or understanding that in the context of what's currently happening in the market. So today we're going to look at a couple of indicators. We're going to look at what a divergence is. We're going to look at a bunch of examples on the charts, and then we're going to do an example trade. Okay, and so first, when we look at a momentum indicator, that would be something like, a MACD. And so when we look at an indicator like this, it uses the distance between two moving averages to identify possible short-term changes in price momentum. And it oscillates from red, which means the sellers have got momentum, to green, where the buyers are kind of more large and in charge, right? And it rises and falls through. Now, some people call this line a baseline, and some people might call it a signal line. We talked about this, at length in last week's class. So if you missed that, you may want to go back and watch that. But, this can be used by some traders as a confirmation of a trade signal. And last week we did an example trading plan, and Cameron will laugh. I don't know if you were with me last week, Cam, but we went back to a 3 green arrow, stock trading plan, example trading plan, where we added indicators that give us a green arrow. Let me just bring up my drawing tool here. I'll move this kind of out of sight if I can. There we go. But it would give us a little, and I'm not going to change the colors, but a green indicator, when something moved here from red to green, it would give us a little green arrow, and then it would give us a red arrow if it moved here. And so if you want to see some detail on just, an example trading plan that uses, these red and green arrows, and then on a moving average, you could add one to give you a green arrow when it closes above a moving average, and then again when it closes below a moving average. And so, we can use these, as additional confirmation of a trade signal that we may be seeing on the chart by looking at these indicators. Okay. Okay. Let me just wipe that slate clean. And so we just talked about the MACD. The other one we talked about last week was the relative strength indicator. And there's often a line at the 70, and when it's above that, some traders might consider a stock to be overbought. And then if it goes below the 30, they might look at it, and consider it to be oversold. Okay. And, it fluctuates between, on the RSI, between 0 and 100. And we've got this, if it's, and we can't really quite see this. I don't know, this image didn't come out that well, but, we've got this signal line, one at the 70 and the other at the 30. Okay. And this is another pretty commonly used indicator. Okay. And so what do I mean when I talk about divergences? Because we can see here that, as the stock was going up, this indicator, our relative strength indicator, was going up as well. And here, as the stock was going up, the indicator was going up. But what happens when they don't play nicely together? Good question. And are there times when they don't, when they are not in sync with each other? And as it turns out, there are. So this is called a bullish divergence. And why do we call it a bullish divergence? Or, why might we call this a bullish divergence when the stock is downtrending? So we can see here, this stock is heading south, but on the RSI, and keep in mind, this is now below the 30. So in oversold territory, even though the stock is falling on the chart, on the relative strength indicator, it's starting to rise. And so when we look at this, why would we call this bullish? Because this could be a sign that this downtrend is running out of steam. This could be a sign. So you might say, ooh, I might want to pay attention here because this could be turning around. Now, does it mean that as soon as you see this, you go, the trading gods have given me a sign and I must buy immediately? No, what it may say is sit up a little straighter, add it to your watch list, and maybe your rule says you only want to add this to your portfolio if you're buying a stock is if it crosses a moving average. So you might say, well, even though I see this divergence here and we had this big candle, until it crosses here, I'm not playing, I'm not buying. And sometimes when it just crosses for one day, you might say, I'm not sure if that's a breakout or a fake out. I'm going to see if it goes up, and if it comes back to retest and bounces, then I'll buy. So, maybe you entered the trade on this day here, which is a couple of weeks after you notice this divergence, and that's okay. And, would that have worked out well had you done that? Well, according to this chart, it would have worked out in this instance not too badly. Okay. So what we're looking for is a mismatch that indicates that the downtrend may be losing strength. And this is why we're calling it a bullish divergence, because this is bearish, this is bullish. Okay. Tyler, you've got it. It is a possible, but three very important words: possible trend reversal. It's not, go in and buy with both hands. This is guaranteed. This is a possibility that the trend may be reversing. And then, on the other side, spoiler alert, we're now going to talk about a bearish divergence. And, we may have had the opportunity to see a few of those of late also, where something is continuing to go up on the chart, but on the MACD or on the RSI, we could see that mismatch, and so you might just say, ooh, maybe this is a sign that if it comes back to this moving average, I want to be sure that, I tighten up my stop. Maybe if you bought this a long time ago, you may want to adjust a stop. And as it turned out with this one, it did pull back, but it pulled back for a short period of time, and then it took off again. Okay. Okay. So, and we can see these divergences on a number of different indicators. We can see them on the MACD, we can see them on the RSI. So when you have indicators down here, we did one last week and we looked at the stochastic also. Our three green arrows was one on the stochastic, one on the MACD. This was our three green arrows. And when I first was introduced to this education, there was a three green arrow trading plan. And then we want to see, on the trend on the moving average. And we used a 30-day moving average. And so we wanted to be able to check those boxes. Okay. Okay. So let's go ahead and look at some charts. And for me, as a client, this was always the kind of part where it seemed to come to life, where I thought, oh, okay, I can now take and actually apply this in the current market condition. And is there only one type of market where these are appropriate? No, we can, this is something that we can look at, on a regular basis and be aware of. And just to keep it simple, I've just put the MACD on here, but we can see this is American Airlines. And the S&P 500 has been kind of hammer smashed of late. It is so far this year down 14.5%. When we look at the NASDAQ, so far this year, or as of this moment, and this could be the bottom for the year, or it could just be a stop on the way down. We don't know yet. But we're down almost 18%. Not to be outdone, American Airlines down 47. And why am I pointing that out? Well, because we're seeing this bullish divergence. So where we had a low here, but then it kept on falling. So we've seen, this series of bear flags, and we talked about bear flags earlier in this series, right? Bear flags and bull flags where something falls. Oops, let me change my drawing tool. It'll fall, try and rally for a couple of days, falls again, rallied for all of one day, fell again. So, both bear flag. And then it's like, ooh, are things changing? But if your guideline was that, you're only going to get back in if it crosses above this 30-day moving average. You'd still be out. Bigger flag on this one, and then it fell again. And then, you know, one-day rally, fell again. So far, one-day rally, is it going to fall again? But what we're seeing here, in spite of the fact that this was falling, this is moving to the upside. But when we have an entrenched trend like this, you know, could it start maybe going sideways? It could. Could this be, you know, what we call a false positive? Like, could, you know, it look like there is actually a divergence here, but does that mean that it is for absolute sure going to follow through? Not necessarily. You know, so, you know, this is, you know, another piece of information. You know, and it doesn't mean that just because we see it, we're going to place a bullish trade. Let's look at Amazon. So with Amazon, and you know, if we go back in time a little bit here to November 22nd, you know, just a couple of weeks after the election, you know, Amazon had been uptrending, and then it came down to the 30-day moving average, and it was continuing to uptrend. Like, it went up nicely, pulled back to around the 30-day moving average, and continued to move up. But on the MACD, we saw this bearish divergence. And how might we interpret that? Because the stock is still going up. Well, it might just be a sign to say, hey, if you've owned this stock for a while, just be careful. And what does being careful in the world of being a trader look like? Well, what it might look like is, let's say you bought this stock at when it crossed this 30-day moving average. Let's say you bought it on this day. We bought it here, and our first stop was here. And, you know, it's continued to move to the upside, and maybe here we moved our stop up a little bit and then moved it up again when it closed below that 30-day moving average, and then moved it up again. Well, you know, now we're heading into the holiday time. This might just, when we see this pattern, it might be a reminder to continue to be diligent about, you know, having our stop in an appropriate place. Tyler is saying maybe you might want to cut your share size. Like, yeah, so maybe if you own 200 shares of this stock, you might say, you know what, I bought it here around this. I don't know what the price was. Like, let's say we bought it around 175, and, you know, it's now trading around, you know, 220 or 230. Maybe I take it and sell 100 shares, you know, if it's running out of steam. Or you just say, well, remember, not all divergences follow through, so maybe I'll just, you know, continue to move up my stop. And if you'd moved up your stop, you'd be out. You were probably out somewhere around here, maybe around that 220-ish mark. And would you be back in yet? Well, it depends on what your re-entry rules are. Because here we saw this bearish divergence. Now we're seeing a bullish divergence where the stock was downtrending, continuing to downtrend, and yet on the MACD, it's now starting to uptrend. So while this was bearish, this is now bullish. And so, you know, does it mean buy today? Well, not necessarily. What are your guidelines for when you place a trade or when you buy a stock, you know, or trade an option? Do you have some entry rules you're looking for? But what this may say is, hey, you know, pay attention, an opportunity might be coming your way. Okay. So on one chart, we've got both a bearish and a bullish divergence. And is that uncommon? Not necessarily at all. Okay, so let's look at CRM. And on CRM, again, a similar story, right? Like as goes the market, so go sometimes many of the stocks within it. And this one is outperforming, outperforming the NASDAQ and the S&P 500 in the sense that it's an even bigger loser so far this year than either the S&P or the NASDAQ. It's really kind of done a Humpty Dumpty thing and had a fairly great fall. But we could see, back in October, this stock was uptrending nicely, but the MACD, we saw this divergence. And again, it may not mean sell immediately, but what it may, that may not be how a trader chooses to interpret that, but they might say, I'm not going to fall asleep at the wheel here and be less disciplined. I'm going to make sure that I manage my position because this is a sign that the winds of change may be upon us. And then, of course, we've had this, continued to have on this stock since, really it hit this high back on December 4th. But, just recently, this stock, like if I come directly up here, it's still fallen. So this is still downtrending on the chart, but we're beginning to see this divergence here. And so this may be a sign, hey, maybe there is an opportunity coming our way, for a bullish trade. And some might say, well, this kind of looks like a morning star, and it does, although that pattern, and we talked about candlesticks, I think back in week 4, technically to be a morning star, you want the body of the middle candle to be smaller. Okay. Okay, let's look at the Home Depot. And we looked at this one yesterday in trading a smaller account. But again, as with so many stocks in the last month, we see this move to the downside, but on the MACD, it's moving to the upside. Now we still have, the last 4 trading days have still been bearish. So does this mean, the MACD has told us that this is now a bullish trend? No, it's saying that the downtrend may be running out of steam. Then again, this could all of a sudden really move, our MACD could catch up with this trend. Okay. How about JP Morgan? And, and here's another one where, in this stock in the financial sector, it hit this high back on February 19th, which was the day that both the S&P, the day that the S&P hit a new all-time high. And I'm not sure if it was the same day for the NASDAQ, but it wasn't far behind. But what we're seeing here, downtrend since, and yet our MACD, here downtrending, but here uptrending. And this hit this was a low, and you might say, well, but I encourage you, if you're wondering, say, well, okay, here was my low, here was a low, and here is what? A higher low. And here's a low, and this is definitely a lower low. And, hence the divergence. Okay. And you'll notice we've looked at a lot of these, but have we placed trades on them? Just because we see something doesn't mean we have to act on it immediately. But here's one. If we look at Costco. So Costco, this is one where we had a low, and then we had a similar low, right? Like if we're looking at this time frame, we had a low, and then we had another similar low. It wasn't really a higher low or a lower low, but here we have a low, and then we have a higher low. And what else do we have? Well, year to date, it's down less than 1%. So it's outperforming in a positive way both the S&P and the NASDAQ pretty dramatically. And so if we look at this and, it went from 800 to 1,078, which is over a 25% increase, from August to, the beginning of February, which is, a pretty, when we look at that, you would characterize that as uptrending, right? And so, could we look at this and say, hey, there is potential that this, support level could hold. It came down to this support level once, twice, 3 times, and today it's bouncing. And so, we may not be confident in the long-term uptrend, but we might say, well, I could see it maybe going sideways or continuing to stay above this 885 level. And could we place a trade? And we could, and we could do like we've done with the others and just keep watching it. But because volatility continues to be high, we might want to look at a selling strategy. And there's a strategy called a short put vertical where we are selling a put. So we're going to sell a put. And what does selling a put do? Selling a put, when we sell a put, we're obligating ourselves to buy the stock at the strike we've sold at any time between now and expiration. So some traders will use this as a way of acquiring shares. Now, some traders will place this trade and they just want to receive the premium. They have a degree of confidence that the stock will stay above that price, and they just want to pocket the premium and not end up owning the stock. Okay. Then now you may say, hey, I can't really, this is a $913 stock. I can't afford to buy 100 shares of anything. So what you could do is say, okay, you know what? I'm going to come below the put I sold and buy a put. And that will help define my risk. Okay. Now I'm not going to make as much money as if I just sold the put, but I'm defining my risk, and it's a way if I have a smaller account. This thing here is a script, and I have it on, it's in the post pinned to the top of my X feed. Okay. And then there are directions on how to load it. If you don't know that, it's all in that post at the top of my feed. Okay, so this is called a short put vertical. So let's go and look at if we can use this divergence and this bounce off a similar support level to our advantage. And so I'd say this is a kind of sort of bullish strategy. So if we came out here to May 9th, earnings is closer to the end of May. And if we look at our chart and say we want it to be below 885. So could we go to maybe 875? And we've got 120 contracts. It's interesting because both of these are exactly 120. I wonder if someone else either did did some type of vertical, a long put vertical or a short put vertical. So we get paid $2 and we're risking how much? We're risking 5. So what's the most we can make? The most we can make is what we get paid when we enter the trade. The most we can lose is the difference between the strikes. So when we look at that and we say, okay, so, sorry, I've got everything linked here. Here we go. So when we look at this, we say, okay, we could afford to risk our theoretical max loss is $298. And if you say, well, I could have, this is almost a $500,000 account, we could afford to risk $1,000. Well, then we could do 3 of those. Isaiah, I'll show you how to draw that line in just a sec. So we're going to put this in our short put vertical, if I have one here. If not, I will create one. Okay, so we're just going to go ahead and send that in. And this is a weekly expiration. And what's the advantage of a weekly expiration is that, you know, we have more choices sometimes on strike. Sometimes with these expensive stocks, you know, we can do a $5 wide strike instead of it having to be 10. Now on this stock, which is pretty heavily traded in spite of its price, this one still does have $5 wide strikes. Sometimes we choose a strike because we want less time so that time decay will be accelerated. So there's a lot of different reasons. And Cameron now teaches the Getting Started with Options series. So you may want to, you know, check that out. Now, could we come out and let's just see when is earnings? May 29th. So could we come out to the monthly and say, hey, you know what? I wouldn't mind having this stock in my portfolio. So, you know, could you just sell a put? If you wanted to acquire the stock, you could say, well, you know what? If it went down to around 850, which is this support level over here, if it came back to around that, well, actually that's at 870. So if it came back around that 870 level, I wouldn't mind owning it. Or, you know, if you have a degree of confidence that that level might hold and you wanted to be able to make more, but you could afford to own 100 shares or afford to have that assigned, you might choose to sell part or all of the position. Could you come here and say, you know what, I'd like to sell that 855 strike and I'd be paid somewhere between 22.35 and 24.10. Now, if you're wondering bid and ask, like I don't trade a lot of options, so I'm, you know, not sure. They always want to sell it. If you're selling, they always want to pay you less. So that's the bid price. And if you're buying, they always want you to pay more. You know, and the market maker makes the difference. And so with this, the probability of us ending up owning the stock based on where it's currently trading and volatility and everything is 32%, which, so that means we have a 68% chance of it expiring worthless and currently, and then we get to keep this $2,200, you know, to $2,400. So if you wanted to do that, you would just click on this and say, okay, we want to sell a put. But what we're doing is obligating ourselves. And there was a question in to one of the webcasts that was taught last week saying, like, hey, if this stock really tanked and say it went down to 810, why would anyone, you know, want to pay us 855? And the answer is, I may not want to pay 855, but I have contractually obligated myself to pay 855 if you know, the person who bought the put chooses to exercise their right to sell. And the only way I can get out of that obligation is if I choose, if I've sold this, is if I choose to buy it back. And if that stock is trading at 810, I'm going to be paying a lot more for it than 22.55. Okay. So, but if that's a risk I'm willing to take, and you know, if you come to confirm and send, it's saying, hey, your risk is 83,000. Well, how can my risk be 83,000? Because I'm buying a stock at $855 a share. I'm being paid $22.95. So if technically, if Costco went to zero, that would be, you know, how much I could lose. And so we're going to compare this to our vertical. And this is based on support and a bullish divergence. So if you're, you know, why did we do this example if we're looking at this? You know, we're looking at a bullish divergence on the MACD. So this is just a note from you to you. But if you're saying like, geez, that's a big potential loss. So you may want to come out and say, okay, I have sold this May 16th put. Let's add some more strikes and see what the probabilities are if we come out a little further. So we sold the 855. There's only a 19% probability that this could come down to 800 at expiration. And if we come down to, the 730, there's less than a 10% chance of it going down to 730. Now, anything is possible. So we did the vertical. If you would be interested in buying the stock, then you may just want to sell the put. And if you actually want to end up owning it, you may not say, well, I'm going to sell this put at 875. You may sell the 900 put, where the probability of it being assigned to you, of it being in the money at expiration, is higher, and you'd receive more of a credit for it. But also, if it's put to you, you'd be paying 900 instead of 875. Okay? Yeah, so Melissa, yeah, thank you for answering that. Yeah, Melissa is just saying yes. Okay, so somebody asked how I draw these lines on the chart. And so let's just take these lines off. So I've just removed them. So if I want to draw a line where we sold the put, so we sold this put at 875, I'm just going to draw this line, and then I'm going to right click and edit. So just draw a line. Yours is going to be skinny and black if it's on the default. And then I came down here and I changed the color to blue, and I changed the style to a dotted line. And then I made it thicker so it's easier for you guys to see. And then I want that to be at 875. And then yours will say show price, do not show. I want the price whenever I draw one of those lines to show on the right as a default. So when I do that, now when I draw the line, it will automatically show up blue, dotted, thicker, and it will show the price on the right. Now, if I want to add something to that, like let's say I want to put the fact that it's a short put and it's expiring in May, I think it was May 16th. I could say show that name on the right. Then when I'm looking at my position and I'm thinking, where was that short put? It's now right on my chart. And when that position, I buy it back, or the stock is put to me, or it expires worthless, which is perhaps the intention, then I can just, take that off the chart. Okay. And then on X, let me just, by the way, this is kind of my cue to remind you, you may want to follow us on X. Oh, now this is stuck. Okay, here we go. You may want to follow us on X, again, Barb Armstrong CS. And occasionally we have imposters and Cameron May CS. But if you click on this, it's the second page. You'll see that year-to-date, month-to-date, week-to-date chart. The script is, and I'll just type it in here, it is LJYKFC3. And notice that they are case sensitive. So I want to point out they are case sensitive. We are not recommending it, and accuracy isn't guaranteed, because sometimes these can be, a little off. And then if you're not sure of how to add that script once you've been given the script, here is how to add a script if you're adding it to a chart. And here's how you add it if you're adding it to a watch list. But what you'll do is you'll just highlight that script. And then when you come to the Thinkorswim charts, you are going to come to Setup, Open Shared Item, because I've shared the script with you. put this in. You always have to hit preview, and then you're going to import it. And this is what I've called it. Now I've already imported it, so I'm not going to import it again. Okay. Now the other thing that you're going to want to do is hit the subscribe button. And you want to come to Trader Talks. If you haven't already subscribed to the Trader Talks from Schwab Coaching on YouTube, when you come to the home page, whatever is currently being taught will show up first. If you come to playlists, so if you're new to the strategies we talked about today, you can go to, here's some options, basics, and strategies. Or if you scroll down to the bottom, you'll see Cameron Mays getting started with options. Oops. But you've got a list here of, of the strategies that we cover, including the short put verticals. And then also, if you come down to the trade management mini sessions, if you're new to Thinkorswim, there's a whole bunch of short videos here on like how to customize a chart, how to add a script, all that kind of stuff. But up here are some example trading plans also. And the short put vertical trade that we put on earlier, there's an example trading plan for that in there as well. Yeah. Yeah, so, if you want to exit that trade, if it's up in the next couple of days, you can easily go in and just buy those trades back to close them out. And typically I will put in an order that says, right when I place the trade, hey, when we've got 80% of our max gain, let's buy this back and we'll close it out. So guys, that's what we had for you today. I hope you found this helpful. We did 2 example trades on Costco. We sold a put, we did a short put, and then a short put vertical. And what you may want to do is just link by clicking on, the little paper clip on your chart, link your chart to a watch list. I went through the Dow 30 and then was clicking through the S&P 500 and just look for these types of divergences and then maybe place some example trades. So if you would hit that like button, what that does is it helps move things up in the algorithm so that it makes it easier for more people to find this content. As Cameron says, it sounds like applause to us also. It lets us know that you liked what you saw today. So hit the like button, hit the subscribe button, and then don't forget to follow us in the land of Twitter. I don't believe that there was a survey today, so you're off the hook on that. Thanks to Cameron for fielding your questions in the chat, and to the guys behind the scenes for helping bring this webcast to life. We'll see you in a webcast coming up soon, my friends. Take care.